Alrighty, welcome everyone. My name is Colin Evans, and I'm part of the business development team here at Baird. On behalf of your advisors, I want to thank you for joining us for today's Baird Wealth Strategies webinar, Give Wisely, Navigating the Financial Landscape of Charitable Contributions. We're thrilled to have you with us. Today, we'll explore the strategic approaches to charitable giving and how aligning your philanthropic goals with tax-efficient planning can help you give more efficiently and meaningfully. And I'm excited to introduce three expert speakers joining us. First up, we have Kate Biaggi-Rickert, Charitable Solutions Officer at Baird Trust, Scott Grenier, Manager of Tax and Estate Planning at Baird Trust, and Jonathan Raymond, Charitable Solutions Strategist at Baird Trust. But before I turn the call over to them, I have a few housekeeping items I'd like to highlight. For optimal viewing, we suggest setting your layout to side-by-side view via the circle in the upper right-hand corner. All participants are in listen-only mode, but we'd love to hear from you. We will host a Q&A session at the end of the call to address as many questions as time permits. You can submit a question by clicking on the Q&A icon. Please be sure to address your questions to all panelists. This presentation is being recorded and will be available along with the slide deck through your financial advisor about a week following today's call. So with that, I will go ahead and throw it to you, Kate.
Great. Thank you so much, Colin. Well, first, just to get out of the way, I like to start with a little bit of legalese. Baird Trust does not provide tax or legal advice, and you should consult your own tax and legal advisors before taking action that might affect you or your entity's tax or legal status. So now we can jump right in with the fun topic of philanthropy and charitable giving. So we know that as Americans, we have a very generous society. Every year, the Indiana University Lilly Family School of Philanthropy provides a report based on IRS data and some supplemental data that covers giving statistics from the previous year. So in 2024, there was a record $595 billion given out to charitable organizations. Where was most of that giving coming from? Well, individuals, certainly with $392 billion. Then foundations, $110 billion. That includes predominantly private foundations that are started by individuals or a couple. Bequests, $46 billion, so that's a gift from an individual or couple's estate plan. And then corporations gave $44 billion. So ultimately, those top three categories are predominantly from individuals, but broken down a little bit, and then corporations coming in at 7%. So who is the beneficiary of those dollars? Well, religion continues to be the top cause that people are supporting. People often give to their faith and to their alma mater. And so you've got education was right there at number 3. And then kind of in between, you've got human services organizations. You can see the other types: healthcare, environment and animals, arts, international organizations and causes. And so those categories continue to always kind of be at those incremental levels. So we know that many people in our society are donating. 2/3 of U.S. adults donate, and you can see that broken down by generation. Yet, surprisingly, fewer than 6% have a bequest or a planned gift in their estate plan. That's certainly surprising that so many are giving during their lifetime, but haven't, for whatever reason, given through their estate plan. So we're going to break that down a little bit more going forward. I ask you to think about why you give. The number one reason people give is typically to support a cause that they value. They might have belief in that specific cause. They might have a personal experience, such as they went to that school or they benefited from services provided by that hospital. It might be that their religion or faith beliefs compel them to give to the causes that are most important to them. Donors also like to see the impact of their dollars at work. And so they're giving to charitable organizations, often within their own communities, and they're seeing the impact of those dollars from reports from the nonprofit, from seeing the positive impacts that are happening in their community. An added benefit, besides knowing that you're making a difference, is that you can receive a current income tax deduction. We'll go into some details about that a little bit later on. And then certain types of gifts called split interest trust allow you to potentially make an irrevocable gift, and then you or loved ones can retain a stream of income. Again, we'll cover those details momentarily. Think about the joy of giving. What are some early memories of giving? I'll let you take a minute and think about that. For me personally, I remember before we would go to church, I'd have to pull $1 from my piggy bank so I could put in the collection basket when it went around at church. My parents wanted to instill that with us. Also, that's giving monetarily, but they wanted us to know the value of giving of our time. And so we volunteered throughout the year, but the earliest memory I remember volunteering is we would volunteer at Walmart at the holidays with the Salvation Army having the bell ringing. And so my parents taught us the importance of giving of both our time and our treasure. Think about what charitable causes are most important to you and how do you like to support them? Again, time, your talents, your treasure, or your ties, your connections, and helping others that have those things help support those causes and getting connected. You can think about, do you currently or want to involve your children and your grandchildren in your philanthropy? Philanthropy can unite a family and help people all learn the joy of giving. It can set a great example for subsequent generations. There's certain giving vehicles that are excellent at that, such as a donor advised fund or private foundation, which we'll discuss later on. And then you could think about, what would you like for your charitable legacy to be through your estate plan? I like to give an example of somebody that was charitable but did not have a documented estate plan. I assume many people on this call have heard of the artist formerly known as Prince. Prince passed away in 2016 and died without a documented will. But don't worry, if you don't have a will, the government's got a plan for you. So no matter what, everyone has an estate plan, whether it's one you formalize with your professionals or the government's got a backup. They will identify your heirs, and then those heirs will split your estate plan. That's certainly fine if that's what your wishes are, but in this example, that's not likely what Prince would have wanted to happen. His estate was valued at $156 million. At that time, the federal estate tax exemption was $5.5 million, and the government got 40% of the value over that. So the federal government took $60 million in taxes. Minnesota took $25 million in taxes, and so 54% of Prince's estate went to taxes, and then the balance went to 6 of his siblings. He had 5 half siblings and a full sibling. Perhaps he wanted them all to benefit from his estate. Likely not, or not at that full level, as it's documented that several of his siblings sued him over the years, so it's likely that he didn't have the best relationship with them, unfortunately, and so he might not wanted each of them to get 1/6 of his estate. Also, Prince was known for being very charitable, and so it's likely that he would have wanted his charitable legacy to live on. And so with a plan, which anybody can do, whether you're a world famous celebrity or an average person, anybody can make an estate plan and document their wishes of what loved ones, perhaps what charities they would like to support. So when you think about leaving a legacy, a charitable legacy through your estate plan and goals, you can support and encourage your values for the community where you've lived, worked, raised a family. You can document and predetermine how your donated assets will be used in the future. You can create a lasting memory of your vision, and you can serve as an example for future generations. There's a tale that they say a person dies twice. First, their literal physical death, and the final time is the last time their name is spoken. Leaving a charitable legacy and that allows your name and your legacy to live on and on. I like to give a positive example compared to Prince of a Baird client that we are happy and honored to continue to support his charitable legacy. So this was a client who worked to help settle his mom's estate and wrote the government a multi-million-dollar check for those taxes. And he approached his Baird advisor and said, "What are the other options? Can you tell me?" And so she reached out to Baird Trust to talk through a charitable estate plan. This donor decided to leave almost the entirety of his estate of $50 million to create an endowment to support the small rural community where he lived and had his whole life. He funded the estate in 2010, 15 years ago, with $49 million. And over the past 15 years, $43 million has been distributed to organizations in the community. There's truly been transformational impact supporting education, parks, the arts, and this endowment continues to grow, so more is given away every year. And so you can see those numbers of it was funded with $49 million, the current balance $83 million, and so the growth has been $77 million between the balance of the investment growth, including those dollars that have been able to be granted out into the community. So now I'm going to turn it over to my colleague, Scott Grenier, who's our manager of tax and estate planning, to cover charitable income tax basics.
Awesome. Thanks, Kate. And couldn't be happier for the work that Baird Trust and Baird on the broker-dealer side does for our clients when it comes to philanthropic interest for our clients. And it spreads wide and far on the different variety of the ends of the spectrum on what type of gifting strategies that our clients are looking to use. And so what we'll focus on at the beginning today is a little bit more on the income tax basics of tax deductions of charitable giving. This is not always the end all be all for why our clients give, although it is a nice additional benefit for lifetime transfer for philanthropic causes. And so let's talk a little bit about what these rules might otherwise look like and why it matters. The first, the amount of your deduction, your charitable deduction, is based on the type of asset donated, as well as the type of charity receiving the donation. Are you giving cash, marketable securities? Are you giving to a public charity or a private foundation? What you give and the dollar amount you give and the type of charity will determine the amount of your deduction in any given year, right? We might want to look at whether we give cash or are we using, again, those highly appreciated assets. On the retirement account side, are we looking at qualified charitable distributions during our client's lifetime to try to keep the distribution from being part of our client's adjusted gross income to potentially help them when it comes to other savings on their tax returns? Okay, and then obviously some advanced strategies as well when it comes into charitable trust, as Kate referred to, those split interest trusts, donor advised funds, and foundations that we'll discuss today as well. So when we're looking at gifting marketable securities, we're looking at our clients' non-qualified positions, non-qualified meaning these are typically in brokerage accounts, and we're looking to find and identify those long-term positions versus the short-term positions. The reason for this is short-term positions that are provided to a charity only receive a deduction up to the cost basis. And the difference between the cost basis and the fair market value is taxable to the client. Whereas long-term positions are deductible up to the fair market value, and the donation does not create a taxable event for our client. So we're always looking at this definition of long-term, which is the trade date for our clients plus a full year in one day. In other words, we look at those long-term positions, we try to find lower cost basis positions that have become highly appreciated. Maybe that's creating an overweight in a certain asset allocation sector. Maybe it's a position that has reached levels within the market that we think it has doesn't have as much growth opportunity in the future, right? Or maybe it's an opportunity that we want to potentially rebalance part of the portfolio and again, drive down some of that overweight in our asset allocations. Once we've identified the potential strategy that we're going to give, we're going to look at gifting of these appreciated assets and whether we're gifting cash, potentially after selling the stock, or gifting the appreciated stock without recognizing it as a capital gain. So you can see in this scenario on the left side, we're showing the wages of spouse 1 and 2, along with a capital gain event of $8,000, a long-term capital gain event. We have our clients' itemized deductions of $10,000 that they're giving to charity. Their itemized mortgage interest, itemized state and local property taxes, coming out with taxes that the client would owe of $40,373. However, if that same client would otherwise have, instead of recognized the capital gain, had gifted the appreciated stock, they wouldn't have the $8,000 of capital gains. They would have the same other deductions that they had prior. And now we can see that the tax due results in a lower tax amount by almost $2,000 for our client. So when we look at different strategies, we're always trying to manage the tax efficiency of the best type of asset to give based off of each person's individual situation. And that is why it is so important when we're looking at situations to understand your full situation, not just maybe what maybe our friends have done or other family members have done. We truly need to understand your unique positions, the assets that you have, the length that they've been held, their cost basis, where they set up in regards to the other aspects of your portfolio from an asset allocation and a liquidity need in the future. Again, we're not trying to always drive tax savings, but at the same point, we want to be tax efficient. It is not, again, why all of our clients provide philanthropically, but it is a large benefit, and we want to make sure that you're getting the best of providing to the philanthropic causes that are important to you, along with some tax efficiency along the way. So when we look at these income tax deduction rules, again, what we'll start with is the type of charity that you're providing to, public charity versus private, and then you'll see the different types of assets that might otherwise be gifted to the charity. Cash, long-term appreciated stock, closely held stock, and tangible personal property. What you'll notice here is that you provide these benefits to a public charity, that the AGI deduction is larger in these cases for a public charity than it is a private foundation. But let's go back to when we think about these AGI limitations. So if I were to give $100 to a charity, and let's just say it was cash, that would be limited to 60% of my AGI. Well, if my AGI then was $10,000, 60% of my AGI would be $6,000, which means I could give up to $6,000 in this year and take the full deduction of the $6,000. To the extent that my contribution exceeded the 60% threshold and I gave, let's say, $7,000, I would be able to deduct the $6,000 this year and carry the $1,000 forward to the next year. So my full contribution or full gift to the charitable organization is deductible. The question is whether or not I can deduct it on my current year tax return or if I will have to carry it forward for future years. Now, when we're looking at charitable gifts and we exceed for a single gift, anything over $250, taxpayer must receive a contemporaneous written acknowledgement before the due date of the client's tax return or the actual filing date of the tax return. Now, with most of the contributions that are going to the various charities, we oftentimes see that the organizations will then send a letter to our clients acknowledging receipt, thanking them for their support for the philanthropic cause, and then also acknowledging the gift that they have received in the amount, whether it is, again, cash or marketable securities. This statement can then be used on your personal tax return to help substantiate the gifts that have been made, and providing this to your tax preparer will ensure that you're following the guidelines as identified by the IRS. And so let's take a look at a little bit at the timing of charitable gifts. I think the one that stands out for me the most is the first one, which is the check, right? What you'll notice here is that if the check is mailed USPS by 12/31 and current dated, then you will receive a deduction for the current year. Now, if you were to use UPS, FedEx, or some other third-party organization for mailing this check, then that will not count until the charity receives the actual check. Again, so it's vital that we consider, if we're going to do year-end gifting and we're waiting till the last minute and you want that deduction in the current year and you are sending a check, that we are using USPS and it is postmarked on that date of 12/31 or prior to receive deduction in the current year. Another one that we see clients often do are these distributions from IRAs, what we'll otherwise refer to as a qualified charitable distribution, a QCD. Well, a qualified charitable distribution is when the funds are withdrawn from the actual donor's account. So if you're waiting to year end and using your checkbook from your IRA to make the qualified charitable distribution, Again, we want to make sure that this is either sent by the USPS date and or in the hands of the charity by that 12/31 deadline. I would guide you to make sure that the charity receives the distribution by 12/31 so that you're not playing with the timing of getting these things done at the end of the year. Always give yourself more room to prepare for these events and plan well in advance for the organizations and then also for yourself. With that, I'm going to turn the next section of this presentation over to Jonathan Raymond from Baird Trust, our Senior Philanthropic Specialist. And with that, Jonathan.
Thank you so much, Scott. I love the comments that both you and Kate had, because it really is a mixture of the causes we support and that being the impetus for making these gifts, but there's also a benefit with the tax saving there as well. And there are some individuals that say, I don't even care about the tax savings. They just want to support the charity. In those cases, it's still about the taxes to some degree, because if you can make an efficient gift from a tax perspective, it actually means you can often give more and have more of an impact to the causes that you care about. So even if taxes aren't your motivating factor, it is a motivating factor in being able to have that impact that you wish. As a result, I want to talk about some of the big three type of giving strategies. Scott already mentioned one, which is giving appreciated securities, but I want to talk a little bit about retirement accounts, the qualified charitable distributions and designated beneficiaries that we can use with those retirement accounts. The charitable remainder trust or charitable gift annuities, those types of strategies that we've already alluded to with having an income stream back to you. And then donor advised funds or private foundations, and then wrap up with just a few reminders of additional opportunities that are out there depending on where you live and where you work. With retirement accounts, and this is important that it is considered a traditional retirement account, which means you have not been taxed on those contributions when you put money into that retirement account. In those particular accounts, tax will be due when withdrawn, whether it's withdrawn by you or your children or other heirs that you might have. For a qualified charitable distribution, you do need to be 70 and a half in the year that you're making that gift, which is an important distinction because you may not be subject to the required minimum distributions yet. Those actually are kicking in now at 73 and will kick in at 75 within the next decade. So you still can make those, again, as long as you are 70 and a half this year. You can also distribute up to $100,000 adjusted for inflation. So that means in 2025 can distribute up to $108,000 from your IRA. If you have a spouse who also has an IRA, they can also do that same amount. It just has to go directly from your IRA to a qualified public charity. And if you are in an RMD status that you do have to take those required minimum distributions, this qualified charitable distribution will actually count against and will reduce the amount that you have to take dollar for dollar. So looking at what does this actually mean in real life? So we have an individual here who, perhaps a widow who does have an IRA and has required minimum distributions of $87,000. Takes those. That is the common approach. Might have other income, whether from Social Security or from a brokerage account or some other pension, some other source of $35,000. In this particular case, we've got an individual who's having an adjusted gross income of $122,000. Now, this individual is able to take the standard deduction plus the additional deduction for being over 65. But this individual would have tax due of $17,149. How can we be of benefit and have more dollars that can be used either for this individual or additional dollars that can be given to charity? In the optimized plan, instead of taking out that full 87, just shaving off the $12,000 that this individual was planning to give to charity and having that straight out of the IRA. What that means is now this individual now only has $110,000 in adjusted gross income, still has the exact same deduction because it's the standard deduction plus the age 65 deduction. every single year that this individual does this is able to save an additional $2,600 off their taxes that are due. What's even more important is for this individual, when they Medicare Part B and D premiums are calculated, that is based off of your AGI, which means not only will this individual every single year save over $2,600, but will also potentially have less Medicare premiums that the individual needs to pay. Now, that is way to give from your retirement account during life. If you want to make that legacy gift and live on for future generations and into the future, you can also do beneficiary designations from those retirement accounts. And in this particular case, you can make them from either 401k or IRA. In those, we look at maybe what is the common plan, what we had always been taught to do over the years, which is just leave a bequest to the charity that you care about. And then maybe leave the majority of your assets to your children. So in this case, again, the left-hand column is the common non-optimized plan of someone who dies with roughly $1 million. $100,000 of that is outside of the retirement accounts, and the other $900,000 is within retirement accounts. Again, common approach was simply to make that bequest to charity. Again, maybe that 10% that we're all taught to give, a retirement account, split that among the children. The problem is the children now, within the next 10 years, have to withdraw all of that retirement account. And they have to do that essentially when they're often in their highest income earning years, maybe living in a state that has a state income tax. It is not uncommon at all for that $450,000 that each the son and daughter receive, that they will have to pay $135,000 each in income tax on those distributions. Pretty big chunk there. Simply by swapping out the bucket of where our charitable gifts are coming from, we can have a tremendous impact. So leaving our children amounts that are outside of those retirement plans, letting them share evenly, then letting the charitable deduction, the charitable distribution come out of the retirement account simply by naming the charity as a partial beneficiary of that retirement account. Since the charity pays no income tax, they get that entire $100,000 that they would have gotten otherwise. However, since the son and daughter now are only getting $400,000 out of the retirement account plus the $50,000 outright out of the last will and testament, now the son and daughter are only going to be subject to $120,000 each in tax over the next 10 years, which means you've effectively given your heirs an additional $30,000. I think that is a very meaningful impact there. And the other real benefit is you're able to simply make that change by talking to your financial advisor. It doesn't require going to your attorney to make that change in your estate plan. Again, a real benefit. The next strategy that we want to talk about is those split interest trusts that have already been mentioned, of charitable remainder trust or possibly a charitable gift annuity. In these particular cases, think of someone who might have a family business or a family farm that they want to sell. And the only hindrance to doing so is knowing that upon that sale, there's going to be a huge capital gain on that sale. You can also think about someone who's been fortunate to work with a single company for decades and may have amassed quite a bit of that company stock. As soon as they retire, they may no longer feel comfortable, as they no longer have the inside viewpoint of how that company is doing. They may not want to have the majority of their assets in a single holding, which means a charitable remainder trust really gives four benefits. One is it can pay the lifetime beneficiary a payout, so a stream of income comes back to the donor. The tax, while not avoided, is at least deferred, so that any of that gain on the sale of the farm, business, or company stock is deferred over the next decade or so until those distributions come out. The donor also gets an immediate tax deduction against current income, And lastly, and probably most importantly, that there is now a much smaller asset concentration risk because assets can be diversified. So what does it actually look like with someone who might have an asset, again, business, a farm, or company stock that might be worth $2 million? Creating a charitable remainder trust, if you were to sell that up front, there might actually be capital gains due of about $400,000. But instead of that, can actually swap and get a current year deduction. So instead of tax due of $400,000, might actually get a deduction of $850,000. A huge shift there. That donor is now, over the next 12 years in this particular example, able to get $1.7 million back to them as an income stream. And the charity that they care about is essentially able to get that entire $2 million. So a really multifaceted way of supporting charity, receiving income, and really managing taxes very efficiently. The next method that we can use here is donor advised funds. I think this is really important because, as Scott's going to mention a little bit, is that there have been some tax changes this year. One thing that those tax changes have just further exemplified is that there is a real benefit to those who are able to get above the standard deduction and itemize if they bunch their gifts in a particular year. Right now, most people, in order to get any sort of benefit from charitable giving, you have to be able to exceed the standard deduction that you otherwise would have received. So either a donor advised fund or a private foundation is able to put aside a pot of money that is going to be used for charitable distributions, whether or not it is actually given out in this particular year. It just needs to be contributed to one of these vehicles in the current year. The idea of bunching is taking those dollars that you would have otherwise given, regardless, over a multi-year approach, and making all of those gifts in a single year. I always like to visualize this. And so again, we have an example is, again, the common plan. We have individuals who want to every year give gifts of $12,000. They might have other itemized deductions of $14,000. The problem is they still haven't even reached the standard deduction. There is no benefit from making those itemized charitable gifts because they could have taken that standard deduction whether they made them or not. If we optimize and say, instead of making those 12,000 gifts every single year, let's make all 3 of those years in one single year. And so in that approach, we are able to have savings of additional $5,000, almost $5,000 on an every 3-year basis. Now, the reason why a lot of people thought that maybe we shouldn't do this is they like the idea of being able to give at the end of every year, and there's that seasonal appeal by the charities. Donor advised funds offer a very effective tool for that because you can set aside that $36,000 that's going to be the gifts that you're making over the next 3 years, set it aside and parcel those gifts out on an annual basis. Not only that, but those gifts will continue to be in that amount, continue to be invested. And hopefully at the end of those 3 years will have grown and you can have even more left over that can be given to charity. Now, in this particular example, this donor would save on an every 3-year basis over $4,600. But think about how we might want to even fund that donor advised fund initially. We might not be able to have $36,000 in cash, but if we do have appreciated securities in an investment account, perhaps we can use that to fund this donor advised fund. Again, you're still giving the same amount, you're just giving more of it up front. Now, if we pair this $46,000 worth of savings in the every 3-year basis with the example of saving almost $2,000 on an annual basis that Scott mentioned with giving appreciated securities, we really can actually save up to about $10,000 every 3 years. And I think that is meaningful to anyone who's joined us today. Donor advised funds and private foundations are similar in function, but different in some of the rules that exist there. If you want to have a large impact going for generations in the future, private foundations are able to be one option there. It's basically a supercharged type of donor advised fund where maybe you can have some family governance type of language. Private foundation is actually its own charity. It does require a little bit more work, although Baird Trust is always happy to aid in the administration of that. In this particular case, because it is its own charity, it's able to do a few more things as well. So if you are looking at what does a long-time legacy a gift might look like and that impact, we can always look at the differences between a private foundation and donor advised fund and figure out what might be right for you. But if you are looking at just that every 3-year type of giving approach, that is definitely where I would focus more on the donor advised fund and just know that that is a powerful strategy. I also bring this up that while a private foundation can give to a donor advised fund, the donor advised fund cannot give to a private foundation. So again, I always like our clients to at least know the differences between the two so they don't commit them to something that might dictate how their future giving might look. Mention this as well because there are a lot of these tools that can be used together. Perhaps that charitable remainder trust example that I gave you, maybe that doesn't go outright with the $2 million after those 12 years to a charity. Maybe it goes to its own private foundation and you now set up a legacy for family giving that you can involve generations to come with. So using these tools together, I think this is why it's always important to have those real deep conversations with your financial advisor and figure out what really is best to accomplish your individual goals. Lastly, there are other opportunities that are out there, and we don't want to forget them. If you are fortunate to work for an organization like we do with Baird that does match our employee giving, then that is a way to extend the impact of your gifts that much further. A lot of times there may also be individuals or organizations that double or triple the gifts that you're making during certain time periods, always looking for some of those types of options. And if you do live in a state that has a state income tax, many states do offer additional tax credits for certain purposes, whether it's an endowment within that state or whether it's for scholarships within the state. A lot of times there are those ones. And so being able to have some of those conversations with your local financial advisor to know what is available to you. And again, being able to make that gift go even further. And with that, I'll turn it back over to Scott.
Thanks, Jonathan. Continuing along with the, on the income tax planning side of where we are today, again, we focused a little bit more on the income tax planning side and all of the different conversations that we have from a strategy perspective when looking at our clients' plan, again, by consulting with their outside professionals, which we'll touch base on in a little bit more detail. But certainly earlier this year, back in July, we did have the One Big Beautiful Bill get passed. And with the One Big Beautiful Bill Act that was passed, there were some modifications to the philanthropic space when it comes to income tax planning for our clients that are effective in partially 2025, but also starting in 2026. And so some key takeaways that came from the One Big Beautiful Bill Act started with the rising of the standard deduction from $15,000 per person to $15,750 per person for 2025. All right. And as we start to look at giving to charities, we know that when we had the CARES Act back during COVID, there was the ability for individuals, if they were not itemizing their deductions, that they could provide up to $1,000 per person to charity and still receive that as an above the line deduction, even if they were not itemizing their deductions, which would help lower their adjusted gross income. And so this rule has been brought back starting in 2026 for clients that are not itemizing their deductions, that they can take their first $1,000 per person and provide that to charity and still receive an income tax deduction. The second component of the One Big Beautiful Bill Act, which is a little bit more confusing to get your arms around, and hopefully our example will help here, is to look at two different components of clients that are providing to charitable organizations and receiving a charitable deduction when they are itemizing their deductions. And what we have is both on the front end and potentially for our ultra high income earners on the back end a potential reduction in their charitable giving deduction. And what I mean by that is what you'll see here is there is a 0.5% AGI floor for charitable deductions starting in 2026. In addition, for taxpayers that are in the 37% bracket, their charitable deductions are limited to the 35% bracket. So what does that really mean? So in this example we'll show you next, we have a client that has an adjusted gross income of $250,000. If they are itemizing their deductions, the first 0.5% of their AGI is equivalent to $1,250. If they provide the first $1,250 to charity will not be deductible, which means the client loses about $400 in charitable savings from their income tax return, since the first $1,250 is no longer deductible. You'll see here one strategy we might look at is to consider what we call bunching your deductions, whereby maybe in the first year we are trying to give to charity an amount that is equivalent of 2 years worth of charitable contributions to get over that floor or to avoid the floor in 2025. And then to use the standard deduction in 26, and then maybe take up to the $1,000 and or $2,000 above the line deduction that comes with the standard deduction. And so balancing out the charitable giving desires of our clients and and trying to determine the most strategic way to maximize the income tax benefits along the way. So that's the floor level. In addition, then we have the higher level for high income earners. We still have the same floor issue where again, we're looking at the first 0.5% of their AGI, client with $750,000 of AGI, their first $3,750 given to charity is not deductible. The value of that loss deduction due to this new floor is $1,388. And then in addition, this client would have part of their income, $123,650, that would be subject to the 37% marginal tax rate. If the client was able to receive a deduction for that $123,000, in the prior, when it was worth 37%, they would have had a deduction of $45,751. But the current value, when you're limited to 35% on a tax bracket level, brings that deduction down to $43,278. The lost value of the deduction here is $2,473, resulting in the client losing deductions and losing the cost of the value of $3,861 as a result of the 0.5% floor, as well as the limitation up to only to 35% of their marginal rate instead of the full 37% rate. So again, just to kind of reiterate this, starting in 2026, there's this new impact of this 0.5% AGI floor. Total itemized charitable contributions above the $1,250 floor are deductible. For this client with $250,000 of AGI, that's a loss deduction of $400, which would be the $1,250 at a 32% marginal tax rate. Again, bunching these deductions and maybe making these charitable gifts in 2025, for 25 and 26, and then using the standard deduction the following year and considering the use of that $1,000 to $2,000 gift of cash directly to a charity as a way to continue to take a little bit of a deduction in 2026. And again, for clients and taxpayers with a $750,000 AGI that are in that 37% highest marginal tax rate, the impact of the new 0.5% AGI floor causes a lost value of deduction of $1,388 due to the floor. And then you have the new impact of the 35% deduction limit, meaning they're not able to take the deduction relative to their 37% AGI, but only to 35%, and has another lost value of deduction of $2,473. So when we're thinking about this, we're thinking in context of what is the overall planning strategies based off of what our clients are trying to accomplish. What types of charities are they interested in supporting? What type of assets are they looking to donate? And what is the timing of these donations relative to the various different strategies, as Jonathan alluded to before, with private foundations and donor advised funds as potentially being vehicles, other types of split interest trust, and or looking at wealth transfer at passing, or even through QCDs, qualified charitable distributions. When we think about all of this, we then think about your team of advisors. It generally starts with your Baird advisor. Your Baird advisor, working with them to identify your charitable intentions and goals. For we can go through and provide education around the different concepts and techniques and strategies that otherwise might be available to you based off your personal facts and situation. We then want to collaborate and be a complement to your outside professionals, your estate planning attorney, your tax advisor. We're happy to work in conjunction with these other professionals to ensure that the strategies we might have discussed with you align to your overall goals, align to your wealth transfer strategy, and are done in conjunction with the thought and consideration and determination of your outside professionals. Your attorney is going to recommend different strategies along the way, coordinate these with your overall estate planning objectives, and think about the income tax and wealth transfer efficient ways of transferring assets. They might provide recommendations on account titling and beneficiary designations to achieve these goals. For example, your estate planning attorney might guide you to name your charity as a primary or contingent beneficiary of various types of retirement accounts. Typically, this excludes Roth IRAs, but not always. But they might consider naming a philanthropic cause, a charitable organization, a donor advised fund, or a private foundation to be the recipient of the IRA upon your passing. As Jonathan alluded to earlier in his example, when we think about tax efficient gifting, providing retirement accounts to charity is very tax efficient in the sense that the charity does not pay income taxes, whereas an individual who would otherwise receive those traditional IRAs and qualified retirement plans would otherwise be responsible for income taxes owed on those distributions. And again, then we want to work with your tax professional. This is oftentimes where we're strategizing different techniques and strategies, and again, being a complement to your outside professional, bringing these strategies to your tax advisor and discussing the merits of executing these strategies in any given year or multiple years, and thinking about the tax potential benefits of being tax efficient in accomplishing these goals. In addition to working with Baird on the broker-dealer side, Baird Trust with both Jonathan and Kate, we work very close with the charitable organizations as well as our clients on looking at private foundation management, charitable remainder and lead trust of those split interest trusts of providing income streams maybe to our clients and or to the charities for a period of time. The fiduciary and investment management oversight for nonprofits are all different things that we engage in here at Baird to work with our clients to help them achieve their philanthropic strategies. As we get close to rounding this out today, we're certainly going to ask you to provide us with any questions that you might have today, knowing that you always have the opportunity to engage with your Baird advisor and for them to bring in any one or more of the philanthropic specialists from Baird into those conversations as needed to help provide further guidance. But opportunities are abound. Charitable giving, whether it is donating your time, as Kate talked about earlier today, whether it is providing monetarily, are both extremely rewarding in their own sense. And not every client can gift monetarily, but oftentimes people do have time, and that time can be very fulfilling in providing to those organizations in ways that we don't necessarily see a lot of today. Charitable gifting can be done very tax efficiently by working with your team of advisors, working with your Baird advisor to identify the causes and the timing of the and then the strategies that might be of interest for you and your family. Again, there's many different ways to give to charity, both during lifetime and at death. For those that want to do it during lifetime to see the charitable causes benefit from these donations today and receive an income tax deduction today, we want to work with you to identify and align that strategy while still maintaining your financial independence and your family's financial independence. wealth transfer at passing, we want to think about how are those charitable organizations going to receive the assets? Is it good for a charity to receive a lump sum, a contribution of $1 million or a couple $100,000 at one time? Would it be best for the organization to receive it over multiple years, including an endowment strategy that could last into perpetuity? Does it make sense to have other family members or close friends involved in determining those charities that should receive the assets after your passing, to continue the family legacy of gifting coming from the next generation? And your Baird advisors are here to help you understand what options are available to you based off your circumstances, your goals, your wishes, the timing, and ensuring that your financial independence and your family's financial independence is achieved, while also assuring that we can accomplish your philanthropic goals. With that, I'm going to go ahead and turn this back over to Colin. And again, we hope that you'll go ahead and provide us with the questions that you might have today. And to the extent your question does not get answered, we will certainly make sure to follow up with our Baird advisors to make sure that you get the question answered and time to ask additional questions that you might have on philanthropic giving. Colin?
Alrighty. Thank you, Scott. And thank you, Jonathan and Kate. Thank you for sharing your insights with us today. We've seen some great engagement from our audience. But as a quick reminder, if you do have a question you'd like to ask, please use the Q&A icon located at the bottom right of your screen. And when submitting your question, kindly address it to all panelists to ensure that it is properly routed. So I will send it back to you. Jonathan, if you want to take the first question.
Thank you. I actually see a couple of good questions in here, and I'll kind of address them together. But question of how much time does it take to set up a donor-advised fund, and how do we decide how much to place in the donor-advised fund? These are really great questions. For a donor-advised fund, it is something you could definitely still do in 2025, and it is something that you would work closely with your Baird financial advisor to set that up. Usually the process for setting that up is going to just take a couple weeks. That's not going to be too bad there. Really the question is trying to figure out how are you going to fund that? So there's a couple questions. One, what you're going to fund it with, and Scott brought up some of those great questions as far as how long have you held the asset, how much is it appreciated. Those are always really good questions to ask. We always want to work with your tax preparer and to try to figure out, we want to make sure that you can always deduct that full amount. Again, you are limited to some AGI limitation on that, but figuring out what is that AGI limitation for this year, realizing that you still can carry it forward for up to 5 additional years. So making that judgment call on there. Ultimately, think about how much you want to give to charity. And again, if we're trying to get above that standard deduction amount, as much as we can pre-fund in a particular year and get up the income brackets on that, means the more that we're going to save in that particular year and have more additional savings as we go on. So calculating that on your personal situation is always important. This second kind of related question was, how long does it take to set up a charitable remainder trust, and if that can be done in 2025? That will require a little bit more time. So if you are considering that as a strategy, I would say immediately talk with your financial advisor, and that does require actually a document to be done. So it will depend on the availability and time commitments that an attorney might have to do that. It is definitely possible to still do that this year, but again, based off of the time constraints that your attorney might have. The one other consideration I would have with that is if you are looking to fund that charitable remainder trust with a farm or business that you might be looking to sell, you cannot already have an existing sale agreement in place. So we need to make sure that that is done prior to that, the sale terms being discussed.
Great. Thank you, Jonathan. And I'll jump in on a question we had about if there's a reliable list of charities in the U.S. and internationally. So there's a couple different places where you can get information if you're trying to research a charity. And one I recommend or look for your consideration is Candid's Guide Star. That is data that comes directly from the tax filings of the organizations, and then GuideStar ranks those organizations on seals of transparency for additional supplemental data that they provide. And so you can research the organization, the history, the programs they're supporting. Again, most of that pulls directly from formal IRS documents, so it's facts that are right there and available. Some others that donors choose to look at are Charity Navigator. And then, you can always ask to meet with a nonprofit and delve into the specific questions that are important to you when you're deciding what organizations that you would like to support.
Yeah, that's a great call out, Kate. And we oftentimes will see clients that might work with their local community foundations if they're trying to provide directly within their own community to identify the areas of interest, let's call it the arts, and then might drill down a little bit further into the arts to determine, okay, specifically what type of organization within the arts category is important to you. And let's identify the 3 to 5 of these in your network, in your region, in your hometown. And then let's set up a meeting for you to meet with the individuals from the organization, someone on the board of directors, to be able to learn more about what that organization is doing, how they're supporting the local community, et cetera. So there are a variety of ways, both for you to do on your own and then for you to engage others in the community to help there. One of the questions we also received, and I think this is a really good one from Jean, which is there a reason not to set up a donor advised fund? And quite honestly, yes, there is. When you have direct interest of providing directly to a charity, there is no reason to go through the administrative complexity for you and your family to establish a donor advised fund only to pass that money directly through the donor advised fund to the underlying organization. All right, just skip the donor advised fund, the administrative process. It'll benefit you, it'll benefit the organization and the donor advised fund as well, of not administratively going through the time. And what we don't need is for the donor advised fund organization to charge a fee on assets that are really just going to flow through their organization directly to the end charity, right? So if we want to go direct to the charities, there's no reason to have that donor advised fund. More often, the donor advised fund is used when we want to put multiple years of contributions in at one time and then spread out the transfer of those grants to those organizations over multiple years versus the 1 year of contributions to get potentially the income tax benefit. And secondarily, if we don't know what organizations we want to ultimately receive those grants yet at this time, and we want some more time to determine what grants should be made and the timing of those grants, is a good time to potentially consider a donor advised fund. But I'd say that consider the donor advised fund in comparison and or in conjunction with a private foundation. We have a lot of clients that would potentially benefit from using a private foundation where they think maybe the private foundation is administratively more complex or costly to create, without understanding then the donor advised fund having those annual about 0.5% a fee each year that is ongoing that you wouldn't otherwise have in a private foundation. And the private foundation can actually become a better, more efficient administrative entity than establishing a donor advised fund. So there's a lot that goes into that analysis, which again, we are agnostic. We come from the lens of education, provide you with the independent ideas and constructs of what is out there, and for then us to work in a collaborative manner with those outside professionals.
And I'll just tag team to jump in as well, that compared to a private foundation or a donor advised fund, a donor advised fund cannot administer scholarships. You can certainly make a grant to a university for a scholarship that they have, and that's completely fine. But a private foundation allows you, the donor, if you're interested, to potentially have a scholarship program where you're reviewing the applicants. There's criteria that's approved and vetted by the IRS to make sure that it's fair and equitable of students that are receiving awards. And so a private foundation allows you to give grants directly to charitable organizations that you have in mind, as well as perhaps if you'd like to also have a scholarship component.
Kate and Jonathan, I know we're running up on time here and wanting to be very aware of our time. But I know one of the biggest questions that we raised before we end here is, what are some of the biggest mistakes that we see individuals make when it comes to philanthropic giving? What comes to your mind?
I think the biggest one is just not thinking of ways that you can give tax efficiently, because ultimately that means whether it's tax savings to you or amounts that you're able to give to charities that you care about and have a bigger impact, it really does mean we have to be a little bit more proactive. So that's one of the reasons why we have this conversation in September, is so that we can definitely make some of those next action steps as we're looking towards year end.
Kate, anything from you before we wrap up here?
No, I think everybody covered it.
All right. All right. I'd just say from my end, it's going a little bit deeper. Oftentimes we identify maybe the charitable organizations that we're interested in, but we don't look deeper to say maybe within the organization, what do we really want to support? Right. And going to that next level of saying, okay, I want to support this area, the arts. Okay, well, which organization with the arts? What program within that organization do you want to support? Are we looking to provide for their general fund to ensure that they can pay their bills and pay the board of directors? Or are we looking to support a specific cause within the organization? And I think that next level of planning is oftentimes where I see our clients stop and say, I did this tax efficiently, I got the name of the organizations, but we don't go to that next level of detail. And that's oftentimes, I think, Kate, for me, you and Jonathan, where we spend some of our time trying to work with our clients and those members in the community foundations to really go that next level into the philanthropic area.
Awesome. Well, thank you again, Scott, Jonathan, and Kate, for your contributions. And thank you to everyone who joined us today. We hope you found the discussion valuable and a worthwhile use of your time. If we weren't able to get to your question, or if you'd like additional information, please don't hesitate to reach out to your Baird contact who can connect you to the appropriate resource. For those interested in revisiting today's presentation or sharing it with others, whether a friend, family member, or colleague, the session has been recorded and will be available in approximately 1 week. And you can access it through your Baird financial advisor or by visiting bairdwealth.com. And if you're not currently working with a Baird advisor and would like to explore that opportunity, you can find an advisor near you by clicking the Find Financial Advisor button on our website. A direct link will also be included in our post-event survey. Thank you again for joining us, and we wish you a wonderful rest of your afternoon. Take care.